So we've talked about RMDs, we've talked about what they are. Now let's look at how they're calculated, how they're treated as far as taxes, how you receive it, and then even how you spend it. So we looked at when it starts. So now in the year that you have to take your first distribution, how do you calculate it? It's real simple. The custodian where the account is will also help you, but it's good to know for your own knowledge. So let's use an example here where again we're using an IRA. We're saying at the end of last year, so the 12/31 balance at the end of last year here is $100,000. You just turned 72. You look up a life expectancy table that the IRS provides. They give you a denominator. You simply divide it. The $100,000 end of last year's value, your life expectancy factor gives you a dollar amount. Now from that dollar amount, this is a gross distribution. This is how much you have to take out of your account. You could take more, but you can't take less in order to satisfy that RMD. So if we're saying, let's take what it is, we'll take it all out. It's showing a gross distribution. It is taxable. So we may decide to have some taxes withheld as well. So here I'm showing an example. We're saying 15% for the federal. So out of that $39.06, 15% is being held back, sent off as a payment to the IRS on your behalf. Here in Illinois, currently there's no tax on any type of retirement income. Pensions, Social Securities, IRAs, 401k, so we're not doing any withholding there. So the net amount that you would receive would be the gross less the taxes withheld, gets you to the net, or this is what you're receiving as far as it could be in a form of a check. The custodian where it's held, maybe it's a Charles Schwab, sends you a check for this amount. It could be a transfer to your bank account, or it could be a transfer to another account. Maybe it's an investment account. And it could be done also with positions. So maybe you hold a stock that you just want to keep holding, you move the positions to a non-retirement account. So maybe a joint account or a taxable account. So that's how it works. So now you've received the money, the net amount. What do you do with it? There's 6 options. You could spend it. You could spend it on lifestyle, living expenses. You could save it. You could put it into a savings account, a checking account. You could reinvest it. So that money could then be reinvested, meaning you buy new positions, stocks, mutual funds, ETFs. You could give it away. So whether it's to a child or a family member, you could donate this. So whether it's to a charity with your cash, or you decide to do a qualified charitable distribution known as a QCD. We have a whole nother video on that topic. That's another option. It goes directly from your account to that not-for-profit. And then the last one here is leverage it. Maybe you have some life insurance premiums. You could pay those premiums with this RMD. So we've talked about when it starts, how it's calculated, how it's treated, and then the 6 options for how you spend it. Again, a lot going on here. This is meant to be a summary, but if we can help you with any of these decisions or explain what has been done or needs to be done for this upcoming year, please reach out. We're happy to help you.